Welcome to Video T1B. This video provides a discussion of the different types of taxes. Some is just an overview, while with others we're going to go deeper into the calculations. The types of taxes are nearly limitless. For everything we do, the government seems to come up with a way to tax it. On top of that, every government jurisdiction finds a way to have their own version of the tax. We'll start with local taxes. These are imposed by the most granular level of government, for example, a city or county. Most of us are familiar with income taxes at the state and federal level, but more and more cities are starting to impose city-level or municipal income taxes. Many of these started as a tax on athletes, but some have expanded to capture even those less athletically endowed. The bulk of local taxes are still derived, however, from property taxes, which are exactly what they sound like, a tax on the ownership of property. Most property taxes are ad valorem taxes, which means simply that they are based on value. In California, where I live, we have a rule commonly known as Prop 13, which means that for the most part, the value is set at the time of the purchase of the house. Most states estimate the value of the property at least every 3 years or so that the value is actually the current market value. Most property taxes have only real property, or more commonly real estate, as the tax base, but some jurisdictions impose a tax on personal property as well. For example, I owned a vacation home on Cape Cod in Massachusetts. The county charged a personal property tax on personal property held by non-full-time residents like me. I had to estimate the value of furniture and appliances in my home. Most personal property taxes, however, are levied on intangible assets, which are largely defined as stocks and bonds owned by the individual. At the state level, most states impose a state income tax. For a few lucky citizens, their states have no income tax. This means most of us have to complete both a federal and state income tax return. However, to simplify the process somewhat, many states, in large part, piggyback the taxable income calculation off the federal amount. Most states also impose an income tax on both individuals and corporations, and a few tax partnerships and S corporations as well. Many states also have a sales tax. The sales tax rates can differ from state to state, and within some states from county to county or city to city. The base on which the sales tax is charged can also differ. Some states exempt unprepared food, clothing, prescriptions, and other basic necessities from sales tax. Although most of us are pretty familiar with sales taxes, most of us are considerably less familiar with use taxes, the ugly stepsister of sales taxes. Use taxes are imposed on purchases from out-of-state vendors that have not been subjected to sales tax. For example, if you purchase a textbook from an out-of-state vendor and that vendor does not charge you sales tax, then you are supposed to pay the use tax on the cost of that item in your state. Many states have a use tax line on their income tax return to make this convenient. The most recent study showed that only 2.5% of all taxpayers report anything on the use tax line. Other types of taxes include excise taxes, which are a little bit like a sales tax, and can be imposed on a measure other than dollars, for example, gallons or ounces. Value-added taxes, or VAT, is imposed by many countries outside the U.S., and we'll discuss those more later. Interesting to note that most countries require retailers to quote prices inclusive of VAT, whereas in the U.S., sales taxes are almost always charged after the fact. Gasoline and airline travel being a couple of the rare exceptions. Think about how the transparency of taxes might change consumer behavior. Other states have severance taxes that are imposed on the removal of natural resources from the state. For example, timber or coal or oil or gas. Severance taxes have been the primary revenue generator for many states, for example, Alaska. Other taxes are out there, such as a tax on fishing equipment or a tax on soda bottles or plastic bags. There's really no end to the things that can be taxed. Now we turn to federal taxes. The three biggies are income, employment, and transfer taxes. The federal income tax has been around since before the 16th Amendment to the U.S. Constitution. However, the 16th Amendment confirmed its legality, providing Congress with the power to tax. Over the years, a number of individuals and groups have argued that somehow this tax is not constitutional or they are not subject to it for a variety of reasons. I'm a citizen of the Commonwealth of such and such, and therefore the U.S. government has no jurisdiction to tax me. You can find a long list of such poorly crafted reasons at the IRS website devoted solely to this topic. The previously mentioned employment taxes are an omnipresent tax that pretty much everyone that works pays. Whether rich or poor, you are probably paying employment taxes. Employment taxes in the U.S. are actually two taxes: the OASDI, more commonly called Social Security, and the Medicare tax. Sometimes together these are called FICA or simply Social Security taxes. The first tax, Social Security, is a two-part tax, as we discussed under incidents, where one half, or 6.2%, is withheld from the employee, and the other 6.2% is paid by the employer. The Social Security tax base is wages, but only up to what is known as the FICA cap. The FICA cap is adjusted each year for inflation, and so it changes from year to year. Wages above the FICA cap are not subject to the Social Security tax. The Medicare tax, on the other hand, has no such cap. It is also a two-part tax with 1.45% each coming from the employee and the employer. Thus, the total tax rate is 15.3% on wages up to the FICA cap, and then 2.9% on wages above that amount. Let's prepare an example of FICA taxes in Excel. Feel free to follow along. Jim has wages of $30,000 and Tom has wages of $5 million. What are their employment taxes? Probably the easiest way for me to show you the solution to the employment taxes is using Excel. Let's start with Jim. Jim makes $30,000. The FICA cap that I've put in is the 2019 FICA cap. That amount is $132,900. So his Social Security base is his wages up to the FICA cap. His wages are clearly less than the FICA cap. So we're going to subject his wages of $30,000 to the employee rate of 6.2% and the employer rate of 6.2% for a total Social Security taxes of $3,720. Medicare is the same base, his wages base of $30,000. 1.45% for the employee, 1.45% for the employer, a total of $870. So total employment taxes for Jim, both the employee and the employer's share, $4,590, which we should know is 15.3%, right? That's 6.2, 6.2, 1.45, and 1.45. Or another way of looking at it would be 12.4 plus 2.9. Okay, so that's the basic version. Let's look at Tom. So recall that Tom makes not 50 million, that'd be great. He only makes 5 million, however. So in this case, his Social Security base is his wages, but only up to the FICA cap. Since his wages are $5 million, he only pays Social Security on $132,900. So the rate is the same, 6.2, 6.2. Total Social Security of $16,479.60. So no matter how much you made in 2019, the most Social Security tax you're going to pay would be that amount, right? You could make $5 billion and you're still only going to pay $16,479.60. I say only, that's still quite a bit of money. Medicare, on the other hand, is not subject to that same FICA cap. The Medicare base is, in fact, all $5 million worth of wages. As a result, 1.45 and 1.45 total ends up, Tom pays $145,000 on his wages for Medicare tax. Total amount, $161,479.60. Note that if you look at Tom's effective tax rate on employment taxes, it is much, much lower than Jim's was. And the reason is because Social Security taxes are considered regressive, meaning what happens is even though your base continues up, because it caps out at this rate, what happens is your tax actually goes to 0% above 132.9. So as a result, often people will describe Social Security taxes as regressive. The last of the big three federal taxes is transfer taxes. These are commonly known as estate taxes, gift taxes, or just death taxes. It did not really work this way, but imagine a world where there's only an estate tax, a tax on the value of your estate when you die. One of the easiest ways to escape such a simple estate tax would be to give away your property to your heirs prior to death, in something we call an inter vivos gift. In order to prevent taxpayers from escaping estate taxes by giving inter vivos gifts, the transfer tax law was constructed as a two-part tax, one for gifts while alive and one for gifts at death. Amazingly, gifts are not taxable to the recipient. Instead, it is the giver that pays the tax on the value of the gift. Tracking every gift made and to whom over time is effectively impossible. So to deal with smaller gifts, the tax law includes an exclusion for any gifts under the gift exclusion limit, which is about $15,000 and is adjusted for inflation as needed. In addition, the current transfer tax regime permits a large lifetime credit against the transfer tax of over $1 million. This effectively excludes gifts of over $5 million in a lifetime. The value of the inter vivos and death gifts are added together. As a result of the generous exemption, only the wealthiest will pay any federal transfer taxes, and so the amount of tax is quite small. Speaking of federal revenues, the current environment has the following breakdown of federal revenues. About 50% comes from individual income taxes, 36% comes from employment taxes, about 12% from corporate, and every other federal tax amounts to about 2%. These numbers vary slightly through time, but they are representative of the last decade or so. How about federal spending? According to the Center for Budget Policy, about 25% of all federal spending is for Social Security. Another 15% goes towards Medicare. Both of these programs are considered entitlements, which means that the law includes a formula by which the payments are made. This was done to prevent Congress from tinkering with these payments. Because the amounts have grown considerably, it now serves to hamstring Congress in terms of budgetary flexibility, when almost 40% of federal spending is by law. Of course, Congress does have the power to change the law, but seemingly no appetite for doing so. It could be that populations served by these transfers are largely over 65 baby boomers and voters, making these programs the third rail of politics. If your grandparents ever complain about welfare programs, be sure and remind them that 40% of all federal spending is directed toward them. To show that 2015 spending is fairly reasonable with respect to other presidential administrations, here is federal spending, albeit with a slightly different categorization, for the last 50 years or so. You can see as the baby boomer bubble grew towards retirement age, and then started living much longer than previously expected, the amount of federal spending on Social Security and on Medicare has blossomed, while defense spending has shrunk. As I like to remind my father periodically, I hope you are enjoying the health care that I am paying for. On a side note, the contributions made to Medicare in previous years are unlikely to approach anywhere near the current costs. Medicare tax started in about 1966 at 0.7% on the first $6,600 of wages. It was initially subject to the same FICA cap until 1994, when the costs were already outstripping contributions by a wide margin, and the FICA cap was removed. If we move more broadly into a global environment, you will see the same income, property, and employment taxes. You would also find that most countries outside of the U.S. impose a value-added tax, which we spoke of previously. To demonstrate how VAT works, Let's imagine a scenario with an extractor, a manufacturer, a wholesaler, and a retailer, and of course, lastly, a consumer. The value-added tax is designed to tax the addition of value made at each step along the supply chain until the ultimate consumer is reached. Its elegance is in the way it enforces itself along the way. Start with E extracting raw materials at a cost of $35 and sells those to M for $40. The VAT equals $40 times 5, or $2, which E charges to M and then pays to the government. In the next step, the manufacturer takes the raw materials and turns them into a viable product that M then sells for $46 to a wholesaler. The VAT equals 46 times 5%, or $2.30, which M collects from E and pays to the government. But M is permitted a credit of $2 for the VAT paid. Thus, the net cost to M is only 30 cents, which is the same as the $6 increase in value times 5%. The wholesaler now sells the product to a retailer for $50. The VAT now equals $50 times 5%, or $2.50, which W collects from R, and then uses the credit of $2.30 net cost to be 20 cents, same as the additional $4 times 5%. In the final step, the retailer sells to the consumer and collects VAT on the entire sales price and is eligible for a similar credit for VAT paid. Ultimately, through a series of VAT charges and credits, the consumer bears the entire VAT cost. The beauty is that if at any step along the way one of the parties fails to pay the VAT, the counterparty loses out on their VAT credit and will likely either report the offender or at a minimum stop doing business with them. In the U.S., a national sales tax seems to be about as close as we could get to a VAT. We currently have no such tax, and our state sales tax system allows goods to be transferred through the supply chain tax-free through the use of reseller certificates. Okay, this video is getting a bit long, but I need you to bear with me just a bit longer while we consider just one more example and concept. Let's start with a story some years ago of a new mall being built at the border of Massachusetts and New Hampshire. One of the critical distinctions between these two states is that New Hampshire has no sales tax, while Massachusetts does. When constructing the mall, the original plans called for all the retail to be on the New Hampshire side. However, during construction, Massachusetts made it clear that Massachusetts sales tax would be charged on any store in the mall, and as a result, the mall was redesigned with all the stores on the New Hampshire side of the border. If you look closely at the bottom corner, you see that the corner of JCPenney was actually nipped off to prevent encroaching on Massachusetts territory. Why do I tell you this? Let's return to our hotels in Florida. Recall that the Osceola Hotel was required to charge less for the room than Lake County. The hotel owner exercises her right to influence politics and approaches the city council and requests the tax to be lowered to 9%. What a great idea, since now hotels in Osceola County will be at an advantage to those in Lake County. The hotel business will be very profitable indeed. Any revenues lost by the lower rate will certainly be made up in the greater volume of rented rooms with the new lower price. This, of course, drives the Lake County hotel owner to petition her county government for a tax reduction, etc., etc., etc. This is known as the death spiral of jurisdictional tax competition. Unless the county or state, or whatever jurisdiction is providing some other means to lower the costs of government services to cover the revenue that will be lost from the rate decrease, this simply means a greater tax on everyone else. Many states and localities offer such tax incentives as a way of boosting growth in particular areas or industries, hoping that in the long run, the tax revenue will ultimately be earned back through future taxes. Okay, We finally reached the end of video T1B on the types of taxes. You can rest assured, this is one of the longer ones in the series. I hope you found parts of it interesting. The next video is on how we deal with changing taxes. Thanks for watching.